It is a sea of red out there. We are seeing a massive drop across the entire cryptocurrency market. Bitcoin, which once seemed unstoppable, has fallen significantly from its all-time high. Ethereum is following a similar path, dragging thousands of other altcoins down with it. For many people who are new to this space, the experience is absolutely terrifying. Imagine checking your investment portfolio, an account you poured your hard-earned savings into, only to see its value cut by 30, 40, or even 60% in just a few weeks. The dream of quick riches and financial freedom has suddenly turned into a nightmare of devastating losses. This is the harsh reality of crypto volatility, and it is hitting the market hard. The impact on everyday people is profound and deeply personal. I have seen countless messages and comments online from individuals who are in a state of pure panic. They invested money they couldn't afford to lose, perhaps taking out loans or using credit cards, believing they were on a one-way trip to the moon. Now, they are faced with the brutal consequences of a market downturn. The stories are heartbreaking. People are losing sleep, their mental health is suffering, and the stress is putting a strain on their relationships. It is a stark reminder that investing, especially in a high-risk asset class like cryptocurrency, is not a game. The numbers on the screen represent real hopes, real dreams, and unfortunately, real pain when the market turns against you. This widespread fear is creating a powerful ripple effect throughout the market. When people see prices falling, their first instinct is to sell. They want to get out before their investment goes to zero. This is a very human reaction, driven by the powerful emotion of fear. However, this mass selling only adds more downward pressure on the prices. It is like a snowball rolling down a hill. It starts small but quickly grows bigger and faster. This cycle of fear leading to selling, which causes prices to drop further, which in turn creates more fear, is known as a capitulation event. It is the moment when even the most hopeful investors give up and sell their holdings at a massive loss, just to stop the bleeding. For those of us who have been in the market for a while, this scene is familiar. We have seen these cycles before. The crypto market is famous for its dramatic booms and its equally dramatic busts. In 2018, we saw a similar crash that shook out a huge number of retail investors. But for the new wave of investors who joined during the recent bull run, this is their first major correction. They have only ever known prices to go up. This sudden and violent drop is a shocking wake-up call. It is a difficult but essential lesson in the fundamental nature of cryptocurrency markets. What goes up very fast can also come down just as quickly. The key is understanding what to do when it happens. The core reason for the widespread panic is a concept called fear of loss. Psychologically, the pain of losing $100 feels much more intense than the joy of gaining $100. When investors see the value of their crypto holdings plummeting day after day, this powerful fear takes over. All logic and long-term strategy go out the window. The only thought that consumes their mind is the urgent need to stop the pain. They imagine the price dropping all the way to zero, and the thought of losing everything they put in is simply unbearable. This emotional response triggers a fight-or-flight instinct, and in the world of investing, the flight is to hit the sell button as fast as possible. This fear is amplified by what is known as herd mentality. Humans are social creatures, and we often look to others for cues on how to act, especially in uncertain situations. When you log onto social media and see thousands of posts about people panic selling, when news headlines are screaming about a crypto bloodbath, and when your friends are all talking about getting out of the market, it is incredibly difficult to resist the urge to follow the crowd. You start to think, if everyone else is selling, they must know something I don't. This creates a powerful feedback loop where the panic of a few spreads like wildfire, eventually engulfing the entire market in a wave of fear-driven selling. Another significant factor is the lack of deep understanding among many new investors. During the last bull run, millions of people bought into crypto not because they believed in the underlying technology of blockchain or the long-term vision of decentralized finance, but simply because of the fear of missing out, or FOMO. They saw stories of people becoming millionaires overnight and wanted a piece of the action. They bought coins based on hype, memes, or celebrity endorsements without doing any real research. Now that the hype has faded and prices are falling, they have no foundation of belief to stand on. Their decision to invest was purely emotional, and so their decision to sell is also purely emotional. Ultimately, many people are panicking because they invested more than they could comfortably afford to lose. A cardinal rule of investing, especially in high-risk assets, is to only use money that you would be okay with losing entirely. Unfortunately, many ignored this advice. They invested their emergency funds, money saved for a down payment on a house, or even funds for their children's education. When you invest money that you need, any significant drop in price becomes a genuine crisis. The fear is no longer just about losing a speculative bet, it is about jeopardizing your financial security and your future. This level of risk makes it almost impossible to remain calm and think rationally during a market crash. While the majority of the market is consumed by fear, a small group of experienced investors sees the situation very differently. They are not panicking. In fact, some are quietly optimistic. This is because they view a market crash not as a disaster, but as a significant opportunity. They operate on a simple but powerful principle, famously stated by Warren Buffett: be fearful when others are greedy, and greedy when others are fearful. Right now, fear is at its absolute peak. For these contrarian investors, that is a clear signal. It is a sign that assets are likely becoming undervalued due to emotional, irrational selling. They see a massive, market-wide sale where their favorite assets are being offered at a steep discount. These investors have a fundamentally different perspective because they have a long-term time horizon. They are not investing for next week or next month, they are investing for the next 5, 10, or even 20 years. They have done their research and have a strong conviction in the underlying value and future potential of the assets they hold. They believe that despite the current downturn, the technology and the network will continue to grow and become more valuable over time. Because of this long-term belief, short-term price fluctuations, even dramatic ones like this, are just noise. They see it as a temporary dip in a much longer upward journey, not the end of the road. Their emotional discipline is their greatest asset. Years of experience in volatile markets have taught them that panic selling at the bottom is the single biggest mistake an investor can make. It is how you turn a temporary paper loss into a permanent, real-world loss. They have trained themselves to detach their emotions from their investment decisions. Instead of reacting to the fear and noise, they stick to their predetermined strategy. They understand that market cycles are natural and that corrections are a healthy, necessary part of any long-term bull market. They have seen this movie before, and they know how it typically ends, with an eventual recovery and new all-time highs. This experience gives them the confidence to stay the course. So, what are they doing while everyone else is selling? They are buying. They see the blood on the streets as a Black Friday sale for digital assets. They have cash reserves set aside specifically for moments like this. When the price of an asset they believe in drops by 50%, their view is not that they have lost half their money. Instead, they see that they can now buy twice as many units of that asset for the same price they were paying just a few months ago. This mindset shift is crucial. It transforms a moment of fear into a moment of opportunity, allowing them to accumulate more of their chosen assets at what they consider to be bargain prices, positioning themselves for substantial gains when the market eventually recovers. One of the most powerful strategies in the crypto world is simply to hodl. This term, which started as a typo for hold in an old forum post, has become a mantra for long-term believers. Hodling means refusing to sell your assets, regardless of price volatility. It is a commitment to your initial investment thesis. If you bought Bitcoin because you believe it is a long-term store of value, then a temporary price drop does not change that fundamental belief. By holding on through the tough times, you avoid the critical mistake of selling at the bottom out of fear. It ensures that you are still in the market when the recovery begins. History has shown that crypto markets can rebound surprisingly quickly, and those who panic sold are often left behind, watching from the sidelines. However, holding can be emotionally draining. A more proactive and psychologically easier strategy is dollar cost averaging, or DCA. This is a very simple but incredibly effective approach. Instead of trying to time the market and buy at the absolute lowest price, which is nearly impossible, you commit to buying a fixed dollar amount of an asset on a regular schedule. For example, you might decide to buy $100 worth of Ethereum every Friday, no matter what the price is. When the price is high, your $100 buys you fewer coins. But when the price is low, like it is now, your same $100 buys you significantly more coins. This method automatically makes you buy more when assets are cheap and less when they are expensive. The beauty of dollar cost averaging is that it removes emotion from the buying process. You no longer have to worry about whether it is the right time to buy. Your decision is already made for you by your schedule. This disciplined, automated approach helps you stay consistent and prevents you from making impulsive decisions based on fear or greed. Over time, DCA averages out your purchase price, reducing the risk of investing a large sum of money at a market top. For beginners especially, it is one of the smartest and least stressful ways to build a position in a volatile asset class. It turns a scary market crash into a fantastic opportunity to lower your average cost. So, while the headlines are filled with stories of chaos and financial ruin, remember that there is another side to this story. A calmer, more disciplined group of investors is not only surviving this downturn, but is actively using it to their advantage. They are holding on to their high-conviction assets and methodically accumulating more through strategies like dollar-cost averaging. They understand that fortunes are not made by buying at the top when everyone is euphoric. They are built by patiently accumulating during the downturns, when everyone else is too afraid to act. This market crash is a test of conviction, and for those who remain calm and stick to their plan, it could be the opportunity of a lifetime.